Okay, still Thursday the 20th, Accounting 2, second video. We're going to move on to a couple more of the exercises and problems in the book. I think we finished up with the practice exercises that are due. The PE. PE stands for practice exercise. The next ones, I believe, are just exercises, which begin on page 37, and I think it starts with EX 1-4, exercise 1-4 on page 38. It's a straightforward one, but it helps us with the accounting equation. So let me share the screen again. And where do I have? There it is, exercise 1-4. Okay. Did I put, oh, those are just numbers. Okay, that's good. Making sure my calculator works here. It says total assets and liabilities of Keurig, Green Mountain, and Starbucks companies follows. Determine the owner's equity for each company. I just threw a little additional information in here. Also, I'm not sure if this example exercise is correct. Yeah, that'll do. That'll work. But I put the accounting equation in. It looks like I might have UQUAT. It just looks wrong to me. Sometimes, do you ever look at a word that you've spelled properly, but it just looks wrong? Yeah. I'm trying not to attribute that to advanced age, but anyway. Assets equal liabilities plus owner's equity. Well, okay. We know that we can arrange that differently. Assets minus liabilities will equal owner's equity then. And so that's what this exercise is helping us prove. So rather than dropping the formula in here for you, which makes no sense because there would have been nothing for you to do, I put in the numbers. We have, and I'll drop the zeros also. So it's in millions. So evidently coffee is a big business. Anyway, again, to sound like your grandfather, there's no way possible would I spend $6 on a cup of coffee. But hey, you know, to each their own. So I'm just going to say $4,002 of assets minus $1,288 of liabilities will equal our owner's equity. You could just do the math and drop the number in, or since I'm lazy, I'll let Excel calculate it for me. This number minus that number will give us our owner's equity. Now, if you don't trust yourself, I'm going to shrink this down. You can do a check figure real quick. Why not do this? Let's test it by saying, what's this number plus this number? All right, it equals our total assets. Great. And then I'd probably go on to just make this complete by saying this number minus that number, so I have a really quick way to see that, yes, everything looks fine. Now I can copy this down. Copy, paste. And let's fill out the next ones. So assets minus liabilities will equal owner's equity. So let's just do the formula. Assets minus liabilities will equal equity. And it does. And if these other two columns I put out there just for my benefit, shows that if I do an F2 on that, it shows that liabilities and owner's equity do in fact equal assets. And this is my check figure, which proves that it does. Now, just for laughs, what if I did the math and I just keyed it in wrong? If I put in here 5,800. And then these two numbers added together will equal this one, which I'm $18 off. So again, that's why I put these columns out here just to double check to make sure I don't key something in with my sometimes unreliable fingers. All right, questions on that one? Simple, just accounting equation review. All right. Let's stop the share on that one. That's exercise 1-4. So today is still the 20th. Let's look at exercise 1-6. Awesome. Exercise 1-6. Let's share the screen. Here it is. Let me shrink it up a little bit. There we are. This is still the accounting equation, and they're just missing certain things. And reminding us how we can use some grade school arithmetic to solve for the unknown. So it says determine the missing amount for each of the following. I don't think I put in formulas. No, I didn't. And that's good. Let me enable the editing. And if I've got the first one, I have liabilities of 556 and owner's equity of 3,374,000. And they're just asking me to drop in what is our total assets. Well, it's using the equation, we just add these two up, and that will equal our total assets. This plus that. I know this sounds like third grade stuff, but what it's really driving in is that these are the things that we just need to know just instinctually. Instinctually? Well, either way, we need to know them very well. And this will help us in meetings. It will help us in analysis. This simple formula is something that we all know, and most of our other business colleagues know, but they forget it because they only took accounting 1 and they stopped. All right, next one. We know our total assets. Our total assets are $6,111,200. We know our total equity, $5,725,000 even. All right, so we know the left side of the equation. We know part of the right side of the equation. All we need to do is do some subtraction. This assets minus owner's equity will equal liabilities. Has to, it just does. So let's do that. Equal sign, assets minus owner's equity is our liability total. And then finally, just like we did in the first exercise, exercise 4, where we knew our assets and our liabilities, then we'll calculate our owner's equity. Still a subtraction question. It's just we're subtracting liabilities this time. We have $2,150,000 of assets. Do I need a note? Yeah, where we go. Sometimes I forget a zero. And we have total liabilities of $812,500. So again, this is just a subtraction formula. Assets minus liabilities equal. There we go. Very simple. Please don't get bored with this. This is important stuff. Let me stop the share on this. It's important to remember. I mean, this is just, again, a basic cornerstone of what we do. One of the things that adds value for what we do is when a non-accounting manager will ask us to analyze things or ask us questions, and then just using these simple things like the cost of goods sold formula or our accounting equation, we're able to perform what some people think are just math wizardry, and it really isn't. It's just we happen to know more about the accounting equation than they do. All right. Next one is exercise 6. This used to be a test question when I gave tests. No, we just did exercise 6. I'm sorry, I just marked it off. Thank you. What's the next one? 8? Yeah, exercise 1-8. Let's share that one. 4, 8, here it is. Let's enable some editing. And this is at the bottom of page 38. Indicate whether each of the following is identified with an asset, liability, or owner's equity. One of the things that I usually add to this is what's their normal balance. Once that dot cam shows up today, we'll be able to do some more of this, just in class. But if you recall what I said, I think on Tuesday, we've got these 5 basic kinds of accounts, and maybe I can add this down here somewhere. We have assets. I'll just use the letter assets, and I'll put the equal sign in. Yeah, you make it a plus, huh? Liability plus owner's equity. Then over here, I'll go a little farther and I'll put revenue minus expense equals net income. These are the 5 basic kinds of accounts: asset, liability, equity, revenue, expense. And the normal balances for each one of these, it will come up in chapter 2, but I want to introduce it to you now because if you've had these classes before, you can already kind of know, you should know debits and credits. Assets have a normal debit balance. Need to add some space in here. See, I'll be doing this with the dot cam when I get it. Liabilities. Now notice here, I can put the equal sign here, equals. Liabilities are going, if debits live on the left, credits have to live on the right. Credit. Owner's equity are also credits. Now revenues and expenses don't live in the equal sign here. I can come up here and maybe just put some sort of a gap. I'll just put a couple of hash lines in here. Revenues then have a normal credit balance. and expenses have a normal debit balance. So these two lines, assets equal liabilities plus owner's equity, revenue minus expenses, net income, then debit, credit, 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 debit. If you just write those two lines down and you commit these things to memory, you'll be, to me, it's great instruction with minimal clutter. All textbooks want to put in, and chapter 2 is no exception, that they want to put in something like this, but they'll say to increase an asset, you need to debit it, and to decrease an asset, you need to credit it. And so they go through this list, and I just get lost in the detail. But if I just remember these two rows, and if I just take the net income off of here and just remember these 10 things, asset, liability, equity, revenue, expense, just asset, liability, equity, revenue, expense, and just remember them in those order. That's good accounting order. Asset, liability, equity, revenue, expense. And then the very next line is debit, credit, 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 debit. If you remember those 10 things in that order, you're going to be way ahead. It's so easy then to reference it out of your head, and then you'll get most of your journal entries right. You'll be in great shape when it comes to analyzing things. But just those 10 bits of information, asset, liability, equity, revenue, expense, debit, credit, 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 debit, done. So to me, this is the Rosetta Stone of accounting. This is the foundation or the cornerstone of double entry accounting. Now, other instructors will just will make it more detailed. To me, that just makes it more confusing. It's just boil it down to as simple as possible, something that just becomes an earworm that you just remember. All right, let's do this exercise. This exercise says, indicate whether each of the following is identified with asset, liability, or owner's equity. Yeah, let's do that, but let's also say, what is the, hold on for a second. Oh, sorry about that. Let's go back up. What is the, what kind of an account is account receivable? Asset, liability, equity, revenue, expense. They didn't ask us for revenue, expense, just asset, liability, or equity. Go through the quick definitions. Assets are things that we own. Liabilities are things we owe to other people. Equity is the stuff that's left over. Accounts receivable. And I'll just kick the ball down the hill here. Accounts receivable are assets. These are things that we own. We own the right to collect from a customer. So let's think of Chris Clark in Net Solutions. He provided some consulting service for a customer that didn't pay for it yet. So Chris has to send out an invoice. So in QuickBooks or Sage 50, generating that invoice triggers this entry: debit accounts receivable, credit fees earned, or consulting fees earned. Now, Chris Clark owns the right to collect money from this particular client. Now, receivables don't do you any good until you turn them into cash. So the second entry is the important part: debit cash, credit accounts receivable. Well, from what I wrote, from what I put down here, asset, liability, equity, revenue, and expense, the normal balance for an asset, let's just put that in there, is a debit. So I just dropped that in there just to remind me that it's an asset with a normal debit balance. I think they wanted us to use numbers on this, you know, that indicate 1 is an asset, 2 is, yeah, okay. If you use 1s and 2s, fine. I'll probably use letters. I'll know what you mean. Accounts payable, the word payable should give us a clue. Assets are things that we own. Liabilities are things we owe to other people. Equity is the stuff that's left over. So just by the word payable behind there, I think that that's a liability. Anybody have another idea? I see a nodding head. That's good. Yeah, this is a liability. I'm going to put an L in here. And I know I'm walking you down these first few. I'm going to expect a little more participation starting in chapter 2. But, you know, for the first chapter and whatever, it's just, now liabilities have a normal credit balance. I had to reformat something there. It was bugging me. Next one down, cash. This is the easy one. Cash clearly is something we own. It should always be listed first on your balance sheet in the asset section, the current asset section. So this is an asset, has a normal debit balance. Fees earned. This is where chapter 1 is a little iffy for me. I don't like the fact that they call this as being related to owner's equity. It is only in the sense that it gets closed into the capital account at the end of the month or the year as a closing entry. But during most of the year, it lives as a revenue account. So here's what I'll do. I'll put in owner's equity, and then I'll put a little slash and put in revenue. Now that's going to have a normal, fees earned has a normal credit balance. A revenue account has a normal credit balance. Land, again, is something that we own. Now, there may be a bank loan on it, there may be a mortgage on it, but we still hold title. You know, when people say, yeah, I bought a new truck, but the bank owns it. No, you own it. The bank has a lien on it. So when if let's say we have a land of $1 million and we have a bank loan on it for $900,000. Yeah, there's a big mortgage on that land, but we still hold title. So that's going to be listed as an asset. And assets have normal debit balances. Now, following that example, if we had mortgage loans payable for $900,000, that's going to be a liability with a normal credit balance. Okay. Rent expense. This is another one. I really dislike the way the book did this. The book wants this associated with owner's equity, but I'm going to say owner's equity / expense. Owner's equity has a normal credit balance, but the expenses have a normal debit balance. I'll make a change to this one, supplies inventory. Supplies inventory, this is something we own, and I'll say this every time we run up against this in our textbook. Remember, in a textbook, supplies is an asset. When you're done with school, supplies is an expense. But in this case, it's going to be an asset with a normal debit balance. Okay. I'm assuming this is review for most of you. I see a shaking head. Okay. So that's even if it's review for most of you, that's why I'm going slowly for the people that it isn't. Because when I first took Accounting 1, it was not review. You already know my story there. You know, I had my minor in music, you know, but I had no idea what a debit or a credit was when I started Accounting 1. So anyhow, Chapter 1 technically doesn't list debits and credits yet. That's Chapter 2. But I want to be sure to introduce it so that you don't focus so heavily on this, on Accounting 1 and that chart we did for Net Solutions and for Cecil Jameson and his attorney at law. That's not how. So, for example, I think the chart was on page 19. That's not how it's done. This is just an example.
Gary?
Yes.
I had a question.
Fire away.
With the rent expense, because it could be either owner's equity or expense, with the owner's equity, wouldn't that be credit? And then if it's like an expense, it'd be debit?
Well, you're exactly right, Andrea. And here's the only reason I put the owner's equity in there is that Chapter 1 is saying that revenues and expenses are linked to owner's equity. And they are, but this is something that we would have to unlearn moving into Chapter 2, 3, and 4. That net income, if you remember what we did in practice exercises 4, 5, and 6, we took net income and moved it into the capital account. And net income is revenue less expense. So expense will eventually end up in the capital account or in the owner's equity account, but it will reduce it. It'll make owner's equity smaller. And to make owner's equity smaller, it has to be a debit. So owner's equity itself should be credits. Owner's equity itself should be a credit balance, but expenses always make that number smaller. It's sort of like writing a check for cash. So good question. And if that's still a little confusing, which it should be, if it's still a little confusing, just keep it in the back of your head, and in a couple of chapters, you'll go, oh, okay. So, all right, thanks. Let's see. All right, I like this exercise. I like anytime we can do some journal entries or identify things, it makes it easier for us as we move forward. All right, it's 20 till. Let's take another short break to get the flat spot out of our butts, get some more water, that kind of thing. So let's make this one, sometime, but let's make this 6, 7, 8, 9 minutes, somewhere in there, and we'll come back and do some more exercises. Talk to you soon. Let's stop the share, stop the recording.